Hello and welcome to another lesson. So in this lesson we're going to be looking at fair value reference points. So we have already looked at what fair value is. We have already defined fair value. So today we're going to be looking at fair value reference points that we're going to be using throughout this course in order to maybe position ourselves or maybe frame a setup. So what are these fair value reference points? So essentially, these are just points in price where we can formulate the idea of whether we are in a premium or a discount based on how the structure of the market looks like. So we've already looked at defining a price range. So once you have defined your price range and you have defined your market, whether it is in a premium or a discount, there are points within the premium or the discount that you want to now reference, specific points that you can now say that maybe I'll position myself here for a buy or a sell based on whether the market is bullish or bearish. So there are three fair value reference points that we're going to be using in this course. Number one is liquidity, and liquidity is essentially the lowest or highest reference point that professional traders can use when the market either takes out buy side or sell side liquidity. So we're actually going to be looking more deeper into what liquidity is and maybe what buy side or sell side liquidity is all about. So number two, it is fair value gap. So fair value gap is essentially, it's just a fair value price point that is inside an inefficiently traded price represented by fair value gap. And then we have the order block, which is essentially a point where market makers initiated their orders represented by an order block. So market makers could be maybe the big banks where they have positioned themselves, they have placed orders, and now the market will want to revisit that area for a future reference point to even, maybe if they are buying, to increase even more buying. So essentially we want to always position ourselves at fair value reference points in order to get the best entry point. So whether you're in a premium or a discount, you want to position yourself inside a fair value reference point, which we are going to be looking at even more deeply, individually, what these reference points look like in price, and maybe examples of how you can use them to maybe frame an entry or even take a position, a buy or sell position. So just as an example, we'll be looking at liquidity, which we have already outlined is the lowest or highest reference point within the fair value reference points. So in this example, we're looking at this is a buy side liquidity. So when I say buy side, it's essentially liquidity that is in premium. So when it is taken out, so it is essentially this high being taken out right here, then the market reverses. So in this price point here, this is a price point that you can be a seller because you're already in premium. So you have already, if you have already defined your price range and you're looking at maybe a potential sell, then this reference point here can be used now to enter a position and sell, maybe to this level and even lower. So the market will poke this high essentially, and then it will reverse. So this is what our buy side liquidity is all about, but we'll go deeper into it in future lessons. A fair value gap, as we have outlined, is essentially a point inside price that has been inefficiently traded, represented by a fair value gap. So we'll be looking at and defining exactly what a fair value gap looks like. But in this example, I've outlined this gap here that I've represented as the fair value gap. So within the range high and low, we are seeing that the market was essentially going higher, but it left this gap here, that now it comes back to reference within the discount for you to even buy even more within the market. So the market was inefficiently traded in this level, and it comes back to rebalance that level. So that's essentially what a fair value gap reference point looks like. Finally, the order block we have outlined as the point where the market makers initiated their orders. So I've outlined here that this is a point where market makers initiated their orders, and then the market rallied. So they essentially bought the market, and then the market will come back to reference that point, and then you'll see more buying to even take out buy side liquidity above this high. So just as an exercise, you can go and identify maybe various types of fair value reference points that we have outlined here, and in various price ranges, and you can start annotating in your journal. So you can also determine maybe current price action if you're in a premium or a discount. So thank you so much for watching. See you in the next lesson.